Welcome to Yahoo Finance Live. I'm Diane King Hall, along with Jared Blickery, or as I like to call him, Professor Jared. Let's get you up to speed on the market action. New week, new money on Wall Street. You have all three major indexes on the plus side as investors go back, return to a risk-on mode. You have the Dow better by more than 400 points, up 1%. The S&P 500 on the plus side by 35. Nasdaq playing some catch-up since earlier in the session, better by just shy of 55 points there. We want to take a look at Treasuries now after remarks from Federal Reserve Governor Michelle Bowman signaled interest rates could stay higher for longer to calm inflation pressures. This coming ahead of another big week for bond traders with a pivotal inflation reading on deck. Yahoo Finance's bond man himself, Jared Blickery, of course, has the breakdown. Jared.
Bondman, I've been called worse. I'll take it. I'm happy here. Let's go to some of the recent action in the Treasury market because it has been a doozy over the last 2 weeks. 3 separate events sending yields higher. And let's cover them one by one. We got the Fitch ratings. Fitch downgraded the U.S. debt. The Bank of Japan, that was a big surprise. They tweaked their bond buying strategy. And the U.S. Treasury, they are increasing their Treasury supply. They announced that last week, but the auctions are ongoing this week. And I've plotted this on our 10-year T-note yield. This is a 3-month chart. And this was the first event. This was the Bank of Japan surprising markets and allowing a 1% on their 10-year, but pledging unlimited bond buying to support that. So we got a sympathy bid up in yields in the U.S. That brought us above 4.0% in the 10-year. That was the first time since about 3 weeks ago. We'll take a look at that in a second. But then came the second event. And let's see if I got this right here. Yes, that was Fitch downgrading U.S. debt to AA+. That was another surprise, not expected in the marketplace. And then we got the U.S. Treasury increasing some of the auctions this week, both bond and bill sales. We have over almost $400 billion of debt being sold this week, split among bills and coupons. So you put all of this together, this has been sending yields higher. This is a 3-month chart, but I want to show you the 1-year chart because we have now punched above 4% 3 separate times. Before this, each time was met with a downdraft. There's 1, 2, this little 1, 3. What's going to happen with this one? You got to think that maybe we're not going to have that downdraft and maybe we're going to go up instead. That has huge implications for the market. Just want to close here with one thing, Diane. I want to show the ICE B of A Move Index. This is over the last 3 months. Now, this is going to be as of Friday, that big green candle. We're going to get another one here in a few minutes as the bond market closes here. This means volatility in the bond market is going up. When that happens, there's less room for equities to perform, less movement, less room for equities in portfolios. So those all get crimped. It's kind of a vicious circle. So Diane, let's go back to you.
All right. Well, I mean, from Bondman to 007, I'm coming up with new nicknames for you, Jared. All right. As earnings season starts to wind down, investors will turn to the next key inflation reading, with July CPI set to be released this Thursday. For more on what this means for markets, we want to welcome in Jeff Klingelhofer, Thornburg Investment Management, co-head of investments. So let's dive into, first I just want to get a broad take on, we had some talk last week about recession calls and starting to wind down those calls. Do you think the market is assessing that right?
From my perspective, I'm concerned they're really not, right? What we've seen year to date is investors just continue to push their expectations of when that recession ultimately hits further and further out the spectrum. From my seat, I think thus far what we've seen is it's moving in exactly the playbook that you would expect. It's just taking a longer time. And so at this point, I worry that investors are just getting a little too complacent, right? They're not pricing in the inevitable, in my opinion, that we are going to get to the end place, and that is a recession. Now, it is taking longer, but still, now's the time to be paring back and playing a little bit more defense, setting yourself up for that.
And Jeff, what if in the meantime, rates simply go up one more time? You had the 10-year threatening to break up. Let's say it goes to 5%. Let's say the short end goes to 6%. What happens then?
Gosh, if we get to 6%, I think it's going to be incredibly, incredibly tough. But again, all of this is just playing out exactly as you would expect. As rates have risen, that has caused everybody, whether that be the consumer, whether that be the corporation, whether it be our fiscal authorities, we have to pare back spending, right? And so the higher it goes, the harder it gets. But from my seat, most of the market is debating whether we get 1 or maybe 2 more hikes. Mm-hmm. Really what we need to focus is on the first 500 basis points that we already have in the bag, right? The ending point to me isn't really what matters. the pain is already there, and it's causing everybody to simply have to pull back, slow down spending, and that begins that march towards the slowdown and the recession.
Are you concerned the Fed is not done?
I don't think the Fed is done, but I think that they're basically done. In other words, my expectation is we have one more rate hike, right? So I think that we'll see that in September. I think that we'll be well set up. And at that point, there's just going to be the continuation of what we've already seen today. It becomes a question of not how far do we hike, but how long do we stay on hold? And again, markets are expecting that once we get to that destination, we immediately reverse course. I don't think that's what we're likely to get.
Well, let's paint a picture for the audience. Everyone is colored maybe disproportionately by their first bear market. So I came up during the global financial crisis, and I remember what things were like back then. But things are different now. When the Fed starts cutting rates, a lot of times it just does it wholesale. We're talking 400 or 500 basis points at a time in a very short period of time. And that's nothing like what the market is pricing in. Yet that's kind of the norm. What do you think about what expectations and their alignment with reality are right now?
I think they're pretty far off, and I think you're exactly right. The Fed usually doesn't start cutting rates until we are actively in a recession. And I think one of the challenges that we have today is the market is saying we might avoid a recession and the Fed will proactively cut rates. I've talked a lot about the Fed used to be a proactive central bank. To me, now they're becoming a reactive central bank, right? We saw it on the way up. It wasn't just when we got inflation above 2%. They had to think it was going to stay there before they started raising rates. I think the exact same happens on the way down. We have to be below 2%, and they have to worry we're going to stay there, and that only happens in a recession. So I think they cut aggressively, but not until we're in a recession.
And one of the things I know that you're concerned about is the consumer, and just fresh data out on the consumer and consumer credit levels. Some data that I am seeing right now showing consumer credit rose by 17.9 billion. That's higher than it was expected. What does that say to you about the state of the consumer?
I think it says it can paint different pictures, but to me it paints a picture of the consumer that's having to borrow to continue to fund yesterday's lifestyle. Right? As rates have risen, it causes everybody to have to pare back their spending, and consumers are having to tap what is that excess stimulus, that excess savings that's now going away. So I think this is classic consumer behavior. You're broadly seeing, especially the low end of the consumer, having to resort to credit cards and other forms of loans to continue to spend, but that will come to an end, and we're seeing that with every bank survey data out there, right? They're paring back their own loan books, and it's getting tougher for consumers to continue to pull forward demand.
And Jeff, keeping with this thought here, what happens? Well, let's just take a typical scenario. Consumer credit, you get a little bit of a crunch, lending standards go up, people don't have as much money in savings. That can create a vicious cycle, but it doesn't always end in recession. You take a look at 2015, maybe even 2018 in certain respects. We haven't seen this really hit the pocketbook of Americans. Even the pandemic was just its own animal and outlier. How should people be thinking about what's happening now? What's the tipping point where this becomes a recession problem versus just a balance sheet problem, maybe?
And that really is the million-dollar question. And so we came into the start of the year, we being the market, expecting that we'd already be in a recession as we sit here today. And we're not. And it's because of the strength of that consumer. But as we're watching the strength of that consumer really begin to pare down, at this point, we're only normalizing, right? We're coming off incredible strength of the consumer. We're just normalizing. So the question really is, where are we heading? But again, to me, all signs point to that consumer is continuing to pull back. I do think that leads to a recession. We are seeing companies' hiring plans begin to pull back as well, right? So it's playing out almost exactly as we expected, just under a longer time frame than perhaps we expected.
So speaking of the longer time frame, we know those student loan payments are resuming this fall. Is the time frame that you're concerned about, for instance, in the fall or further out now?
For me, it's further out. So you're right, the student loan payments, they're slated to begin later this year, but there's a 12-month window that you get to step back into them. So really our base case at this point is a recession in the first half of 2024, probably even the first quarter of 2024, and we're starting to see the signs of that poke up even today. One of the things that we're watching with the consumer in particular is the roll rate from 30-day delinquent to 60 days delinquent. Right? That's where you go from, gosh, I missed a payment, I forgot, to I never intended to make it at all. We're seeing that tick up, and that's a little bit of a concerning sign. But again, we're seeing it mostly pick up via the lower quality subprime consumer.
Makes sense. Something to keep an eye on. While we still have you here, and we got a few minutes, want to get to some of your stock picks and what you like here. You're advising a barbell approach with high quality fixed income, and you got a couple tickers you want to talk about too.
Yeah, I think especially from the fixed income side, right? Yield is back, right? Income is back within fixed income, and that is a very different paradigm than we're used to in the world of fixed income. That inverted yield curve sets up an environment where you can build a very high quality portfolio and you don't have to take a lot of risk. So within fixed income, we're focused on very acyclically oriented companies. We're focused more short on the duration spectrum, taking advantage of that inverted yield curve. I would say on the stock side, we like some of the acyclical picks. So CME Group is something we've talked about. We think they're under earning. It's the world's largest derivative exchange, and it benefits from rising volatility. So again, as volatility picks up, their earnings pick up, and it's an interesting pick from our perspective.
And what would you say, given just this barbell approach, what would you say that you're steering clear of in terms of how you're positioning or advising to position your portfolio?
Yeah, as we're talking to clients today, right now is the time to be putting your portfolio in a very defensive position because you're not having to give up those future returns in order to do that. And so the thing today, right now, is focusing on defense and being ready and nimble when the tide does turn.
All right, we're going to keep it there, but really appreciate you stopping by and all your insights. Jeff Klingelhofer, Thornburg Investment Management Co-Head of Investments. We're just getting started here on Yahoo Finance Live. Coming up, we got Tesla shares falling after they announced Chief Financial Officer Zachary Kirkhorn has stepped down. So what's next for the EV giant as concerns pile up? Plus, earnings season rolls on. We're going to break down the numbers from Palantir, Paramount, and much more after the closing bell. And of course, Barbie is the newest member of the $1 billion box office club. And one analyst says the film could boost share prices for a specific theater. Guess which one? Stay tuned for that and much more when Yahoo Finance returns.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Let's do a quick check of the market sponsored by Tasty Trade. And just looking at the Wi-Fi Interactive, we have a rally underway led by the Dow. You can see that's up about 1%. The Nasdaq is a laggard, up about 0.4%. The Russell 2000 just barely in the red there. Also want to get a quick check on the VIX. That is off about 1 point today. You can see carrying a 15 handle. And just want to point out something. We are up over the last 3 days here.
All right. Well, despite Apple clocking in its third straight quarter of declining revenue, the tech giant staying on the path of share repurchases. Here with why that may bode well for buyback advocate Warren Buffett, we have Yahoo Finance's own Ali Garfinkel. Ali.
Hi, Diane. So Berkshire Hathaway, Warren Buffett, they're sitting on a lot of cash right now, $147 billion as it was revealed this weekend. Now, Buffett is probably getting richer, and that cash pile is definitely nearing its all-time high. And of course, the question is, why? In part, the answer goes back to Apple. It goes back to buybacks, something we've heard about a lot. And I'm going to walk through these mechanics for you a little bit. The first thing to know is that about 40%, a little bit more of Berkshire's portfolio is Apple. And Apple's buyback practices have been indirectly impacting that cash pile since 2016. Now remember, when a buyback happens, guys, reducing share count, bolstering value, and frankly, on the case of management, in case of the management from Apple, telegraphing the confidence that the stock is undervalued. Last quarter alone, just so you get a sense of the scale we're talking about here, $18 billion is what Apple bought back of its own stock.
Yeah, and a lot of that is just to match what they're paying out in shareholder compensation. That's a footnote here. What is Washington doing about buybacks? We've seen this kind of be a political football in the past. Sometimes it goes somewhere, sometimes it doesn't. But what's the latest there?
Well, I don't think it's hitting the end zone anytime to start there. I know. I was very proud of it. Yeah, I don't think it's hitting the end zone. I mean, President Biden has absolutely pushed back against buybacks. He's suggested raising the tax on buybacks. However, I will say that while this endangers buybacks, there's no touchdown happening anytime soon. This is a really entrenched practice, frankly. Remember, Apple in its case, just Apple, right? They routinely can buy back the most stock of any company in the world. And since 2012, they've spent more than $573 billion buying back their own stock. And in this respect, I would say Buffett and Apple are cut from the same cloth. Their insistence on buybacks in both word and deed, I think, is really important. Apple, just with the sheer amount of money they're throwing at it. And I'd actually like to leave you guys with something that Warren Buffett this year wrote about buybacks and, frankly, the politicians who oppose them. It's a little savage, guys. When you are told that all repurchases are harmful to shareholders or to the country, you are listening to either an economic illiterate or a silver-tongued demagogue, characters that are not mutually exclusive.
Wow.
I'll go for the silver-tongued demagogue any day of those two.
Oh my God.
Really? I don't know. Economic illiterate? Yeah, no, silver-tongued demagogue sounds
hard.
better.
Wait it.
Yeah, I don't know.
You don't like either of them?
Great, yes. But I love the football analogies, gearing up for football season. All right, Ali Garfinkel, thank you so much.
And PayPal announces the launch of its U.S. dollar-backed stablecoin. With this release now, the fintech company aims to, quote, contribute to the opportunity stablecoins offer for payments. Here with the details, we have Yahoo Finance's Jennifer Schonberger. Jennifer, this is a pretty big deal, am I right?
Hey there, Jared. Yeah, that's right. PayPal officially announcing its first ever U.S. dollar-backed stablecoin to connect fiat dollars with cryptocurrencies. Known as PayPal USD, the stablecoin is 100% backed by U.S. dollar deposits, short-term U.S. treasuries, and cash equivalents. It is redeemable 1-for-1 for U.S. dollars and is issued by Paxos Trust Company. Now, starting today and rolling out in the coming weeks, PayPal says U.S. customers who purchase PayPal's stablecoin will be able to transfer PayPal stablecoins between PayPal and compatible external wallets, send individuals payments, fund purchases, and convert any cryptocurrencies supported by PayPal to and from PayPal's stablecoins. Now, PayPal's launch of a stablecoin comes just after the Republican-led House Financial Services Committee passed legislation at the end of July to regulate stablecoins. That legislation would permit companies like PayPal to issue stablecoins, something that Democrats are opposed to. Democrats also dislike that the bill grants no actual enforcement authority to the Federal Reserve for issuers with state licensees. House Financial Services Committee Chairman Patrick McHenry saying this in a statement, quote, clear regulations and robust consumer protections are essential to enabling stablecoins to achieve their full potential. That's why it's more important than ever that Congress enact legislation to provide comprehensive digital asset regulation, especially for stablecoins. Now, PayPal says its stablecoin will soon be available on Venmo. Guys.
All right, Jennifer Schonberger, always with great insight. Thank you so much.
Thank you.
Coming up, home prices have reached record highs in more than half of the major markets. We're diving into the latest housing hurdles, when Yahoo Finance returns.
I think they would both fold in 5 seconds. I feel like Mark would bring some moves, but in the end, Elon would beat him.
It may be wise to have some sort of contingency plan.
I'll take Elon.
No need to rush, Look, what's the hurry?
Definitely Mark Zuckerberg. He seems like someone who would go a little crazy and beat Elon Musk up, and Elon Musk is like all talk. It'd be embarrassing for him, I think.
I think that's gotta be true.
I think Mark may have the skills.
I do think it's going to be very interesting to see how this plays out.
I'll put my money on Elon, though, because I feel like he's a little crazier.
Oh, wait a second. That's the exact opposite.
People say that Mark Zuckerberg actually does like some form of martial arts.
I like jujitsu. I also really like MMA. We have like a mini academy in my garage.
So I guess my money's on him.
It's awesome. I got like a ton of my friends into it.
I don't care.
I don't know. I think Elon Musk probably.
Hopefully this can serve as an inspiration for excitement about the future.
I think if they both managed to kill each other, the world would win.
New data showing home prices have reached record highs in more than half of the major markets. That's according to research out today from the real estate fintech company Black Knight. It found prices are still rising, but at a slightly slower pace compared to previous months. Now, it's a boost to homeowner equity levels, but as mortgage rates near 7% on average, many are holding on to homes for longer, causing an inventory crunch in the market. Here to discuss further is the Vice President of Black Knight's Equity Research, Andy Walden. Andy, thanks so much for joining us today. All right, let's dive right into some of your numbers that you all produced in your report. We're seeing that prices have peaked in or reached new heights in 30 of the 50 largest markets. Where are we seeing the largest increases?
Yeah, absolutely. And really it's Midwest and Northeastern markets. It's markets that didn't cool down quite as much last year. They're more comparatively affordable. They have deeper inventory deficits. So that's where you're seeing the markets that are the furthest up is kind of that Midwest and certainly Northeast, kind of centered around Connecticut. And then the areas that are the furthest down, certainly Austin, Texas is really the one market that's still in a very corrective type environment, and really across the Western U.S. they're down from last year.
Andy, could you just kind of outline what an unusual circumstance we find ourselves in for the U.S. housing market? According to your own notes, affordability is the worst it's been in 37 years, but we have very low delinquency levels because people are locked in at lower rates. I'm just wondering if there's a canary in the coal mine when we think about what happened with the global financial crisis. Back then, we had people with multiple properties, and they were using their houses as ATMs. Anything like that going on today?
It's not, right? When you look at home affordability, it's very similar to where it was in 2005, 2006. And so certainly that catches your eye. And as we all know, we have significant affordability challenges out there in the market. In terms of risk of mortgage performance, significantly less risk than there was last time around, not only because of the quality of mortgages out there in the market, but because of the lack of that adjustable rate activity out there in the market as well. In 2006, you had a quarter of the mortgage market that was made up of adjustable rate loans. Today, it's 5%, and very little reset activity set to take place over the next few months. And the 10.5 million folks that took out rate term refis are still benefiting from those low rates right now. And so mortgage is really affordable for folks that took them out prior to 2022. Little different story for folks that are shopping for them today. And
I got to ask you, Andy, some of your research showed that the number of underwater homeowners, to Jared's point, it's on the rise. Obviously not nowhere near the levels that we saw during the financial crisis and that housing bubble that we saw. Is there any potential for this to go much higher and there to potentially be a housing bubble, or is really just the inventory is not there, so it can't happen now?
Yeah, is there the potential? Absolutely there is, right? There's a lot of downward pressure on price from the lack of affordability. As you mentioned, inventory holding those prices high. So when you look at underwater mortgage holders, there's only about 0.65%, about 344,000. Now there's two ways to look at that. One is, hey, it's up 70% year over year. That's concerning. The other way to look at it is it's still historically very, very low. We still have less than 4% of mortgage holders that have less than 10% equity in their home. They're even close to underwater. So still very strong from a historical perspective. And the needle is moving in the right direction given how firm and even strong prices have been so far this year.
And I think it's fair to characterize overall, this is a seller's market, but this is a very big country that we live in. There's a lot of disparate regions within the U.S. And are there any places where one might find a bargain, if we can even use that word, in this market?
Yeah, probably not a bargain. Probably isn't the right word, right? But there are some more affordable areas of the country, right? Everyone is less affordable. If you look at the 100 largest markets in the U.S., everybody's less affordable than their long-run averages. But when you look at places that are a little bit closer, it's your Midwest, it's your Ohio. You've got some heat in Connecticut, right? So it's some of those Midwestern markets that aren't quite as volatile, that didn't see that massive run-up in prices or as big of a run-up in prices in 2020, 21, 22, that are more affordable today, that maybe you could, I don't think I would even use the word snatch a deal, but get closer to that, right? Get a little bit more balanced in your efforts there.
Andy, I love the shout out to my home state. I'm originally from Ohio, actually. So shout out to Ohio. And to your point, for instance, the home my sister lives in, it would be a shoebox here in New York for that same price. And Jared made the point about it being a seller's market, but is it really, you know, when you think about it? Because if a seller puts their home on the market, they have to go and try to find a new home. And with affordability where it is, that challenge, I mean, how do you resolve this pickle if it's not a seller's market and it's not a buyer's market? And I've asked this to one of our guests recently, who is winning here?
I think the answer is nobody, right? Nobody's winning right now. I mean, it is a seller's market by the numbers. If you look at months of inventory out there, it's 2.9 months. It's firmly in the seller's camp. But you're right, it's not a sell and rebuyer's market, because you can get the price you want on the sale of your home, but then you're having to go out there, give up your low rate, and compete at higher interest rates and higher prices. And so really, I mean, to your point, there are no winners in today's market, right? It's a challenging market for folks trying to relocate, certainly a challenging market for folks trying to enter in. I think the winners are existing homeowners, right? We talked about equity getting back to near record levels. I think those are the folks that, you know, have locked in those low payments, have locked in a low purchase price, that are seeing the benefits of those low rates in their equity grow. I think those are the winners in today's market.
And if we think about the current 30-year mortgage rate, how much does that need to go up to create some real hiccups in the market, finally seeing some people completely priced out? Or on the flip side, what if it goes down? Is there any threshold that just opens the market up in the other direction?
Yeah, it's a really good question. If you see interest rates go up, the problem is it's a double-edged sword, right? So certainly it prices folks out, but it locks folks more into their existing homes as well. So you're reducing demand, but you're also reducing supply at the same time. And we're already seeing that with interest rates at 7% right now, which is why the Fed is having a challenging time bringing affordability back into whack, because they're reducing demand, but at the same time they're reducing supply, and it's just kind of locking the market up. In terms of when do we start to see the market unlock on the way down? Mm-hmm. I think you would see demand come back kind of gradually on the way down. And even when we've seen interest rates get down into the 6.5% to 6% interest rate at points in time, you'll see borrowers return to the market. My question is, when do sellers return? Because we haven't seen that. Even when interest rates have begun to ease a little bit, we haven't seen those sellers dip their toes back into the market. And that's the more concerning part for me.
Yeah, that makes sense, Andy, especially when we consider what the Fed may do at its next meeting. And if we continue to see them on the path where they are, as much as some people expect them to kind of hold the line, they've said it's a data-dependent Fed. So we'll see. We'll see what happens if we actually have answers to these questions. All right, Andy Walden, Vice President of Black Knight's Equity Research. Thank you so much for joining us today.
All right, thank you.
Got it.
Tesla shares down today after the EV maker revealed in a filing that Chief Financial Officer Zachary Kirkhorn has stepped down from the company as of August 4th. Kirkhorn served as CFO for the past 4 years and has been with the company for 13 years. For more on what this means for Tesla moving forward, we want to welcome in Colin Rush, Oppenheimer Senior Analyst. Colin, thank you for being here today. At first blush, sometimes when you learn about a CFO suddenly departing, that could be bad news. Not seeing it really take a hit on Tesla stock today. What's the significance of this?
From our perspective, there's a couple of things going on here. One, working at Tesla is an intense experience by all reports, and so I'm sure there was some element of burnout that the departing CFO had here, having been there for 13 years. Also, promoting the chief accounting officer, keeps the cultural integrity intact of the financial organization, and someone that's been involved here with the company for 4 years, and so this feels like a potential natural evolution of the financial organization for a company that continues to see a certain amount of turnover just as folks work through their positions and then decide that it's time to move on after a certain period.
And Colin, I want to ask you, though, one of the questions that's come up is just what this does to succession planning for Tesla. Do you think that this causes a serious concern for the company?
I don't think so. I mean, the company has not had an issue attracting talent. It's been one of the more successful companies here in the past decade, if not the most successful from a stock appreciation perspective. And so there has not been an issue on bringing new folks into the organization and bringing very talented folks, particularly on the engineering side. Within the financial organization, it's a little less transparent in terms of who's doing what and who are the key players. But by all intents and purposes, the company's done a very admirable job of developing an efficient, lean financial organization that's really served the mission of the organization.
And if you could just bring us up to speed from your perspective of how Tesla is monetizing its IP. That is, it has this big moat. It's been collecting data on its customers for a decade, maybe longer. Other competitors don't have that advantage, at least in terms of length of time. And then it's going about this in various ways. We have the Dojo investment, we have full service driving. How much is this paying off, and what's the timeline to really make this pay off in terms of revenues for the company?
I mean, it's an interesting question in terms of where their IP is. We really start with the basic material science on the battery level, and how that understanding of material science goes through the entire powertrain into the vehicles, and then how to make vehicles, and then how you navigate those vehicles on the road. That's one whole segment of IP. On top of that, they've developed actually a quite nice stationary energy storage business where they're monetizing IP there. And now as we move deeper into the AI space, we'll see how they actually monetize this. So far, the full self-driving has been a little bit limited in terms of the ROI for them. They've invested an awful lot of money over a number of years, and they still have they have some revenue to show for it, but there's an awful long way to go for the organization. But the key areas for us have been in terms of building this user base on the vehicles with the optionality around some of these other products that they're building around the vehicles, and then moving into both the utility space and the home energy space with the stationary storage platform and a little bit of solar.
And Colin, I want to ask you, we also saw news about Elon Musk possibly having to have surgery. He, I don't even know if we call this a tweet now, tweeted this, I suppose, for lack of a better word. I don't know if there's new lingo for the X platform. Is that a concern when you think about both this news with regard to the CFO and then just potential health issues for Elon Musk? Does that register as a concern for you?
Yeah, I mean, there's principal risk for this organization with Elon, right? If he ends up having to step away or step down, I think there's certainly a lot of investors that really see him as the visionary that's pulled this whole organization together and continues to lead it. I have a hard time believing that he would step away even for illness for a very long period of time. It seems that he's been devoted to building these companies and really leading Tesla. And so as that situation evolves with his personal health, we'll have to reevaluate. But I have to imagine that he'll continue to be involved as much as he can. And there's also been, I think, a more robust infrastructure built out for the company in terms of senior management and a couple of layers of senior management. We certainly saw that on display at the Analyst Day in March in Texas. And so I think, they're mitigating that in a variety of ways as the organization grows. But it's hard for me to believe that Elon would step away for very long unless really forced to.
And Tesla has been a leader in taking the reins in price cuts. They've been first to market on a number of different models and kind of led the way, paved the way for other automakers. Is that round of price cuts, do you think, over now, or is that something that we're going to see maybe ramp up later in the year?
We've seen actually fairly strong sell-through on vehicles through the first part of the year, and part of that has been modulation on pricing. As we get into the back half of the year, and we look at where interest rates hopefully flatten out here in the short term, we'll see how vehicle sell-through continues on. For Tesla, they had been capturing a fairly substantial premium, and as they've ramped up a fair amount of volume on the production side, they've been taking share from a lot of folks, and sometimes you have to incentivize the market to adopt the products in a different way when you're taking share that aggressively. And so my sense is that we're getting close to the end of those price cuts short term. There's going to be an awful lot of activity around share gains and shifting in terms of which vehicle makers really do ultimately succeed. What we continue to see though from Tesla is that they've innovated on the technology and the cost side ahead of peers, and continue to drive market share just by having structural cost advantages in terms of the vehicles and on the manufacturing front. And so they have the option to, I'm not sure we're going to see it here in the back half of the year, but they certainly have the option to drive share with those price cuts if needed.
And Colin, I know in your last research that you all put out in late July, one of the things that you were questioning was just Tesla's timeline for monetization of AI. What are you looking for from Tesla with regard to that now?
The first application on the AI is the full self-driving, and so they've been able to roll out a certain amount of functionality. What we really want to see is the actual use of the investments that they're making in terms of compute power into other areas, and it still seems premature to speculate on where that actually ends up. But the first one is on the full self-driving functionality, and they've done a reasonable job with that, but certainly are substantially later than they had anticipated in terms of being able to bring out fully autonomous vehicles. And so that's the first one that we'd look at, and then we'd be looking for an incremental monetization from the JoJo investment down the line, but it's hard to tell just yet where it's going to come from.
And we had time for one more. I want to ask about the rollout of buildup, I should say, of the infrastructure behind charging stations, finally partnering with some of the other automakers, but really having been a leader in this. Can Tesla maintain their edge, and who do you see winning the infrastructure war here with respect to these charging stations?
So the infrastructure investment that Tesla made really was about enabling vehicle sales, and they've spent billions of dollars in building that infrastructure out. There's a couple of things that we think about with this. Is one, that's sunk cost on the marketing front for Tesla, and this has been a way for them to help drive some standardization in the industry, which we think leads to cost reduction. But it's also a way to recoup some of that investment by providing the access to other OEM customers. But at the same time, it becomes a real branding exercise for Tesla in terms of being able to attract all of those vehicle users to their stations. When we look at the infrastructure opportunity, it's still very nascent. We look at ChargePoint, ticker CHPT, as a real leader in that space from both a hardware and a full operating and service perspective. They really are the leader in terms of the back-end software and the management of a full network, in the infrastructure space and the public charging space. And so, besides Tesla and all the benefits that they accrue by having all of those impressions on consumers, we really see ChargePoint as the big winner here in the charging infrastructure space.
All right, we have to leave it there. Really appreciate your insights. Colin Rusch, Oppenheimer Senior Analyst. Coming up, Barbie is officially a billion-dollar blockbuster, and it's helping boost theater shares over the last month. But can the trend continue as the actors' strike persists? We're going to discuss on the other side of this break.
morning. This is Yahoo Finance.
Big news. 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investors Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
It is official. Barbie is a blockbuster hit. The Mattel-Warner Brothers collab has surpassed $1 billion at the global box office. Greta Gerwig making history as the first woman to solely direct a billion-dollar movie. Yahoo Finance's Alexandra Canal has more. Take it away.
Hey, Diane, I know. Just 17 days after its debut, Barbie joining the $1 billion club. And it's the second movie this year to do that. Remember the Super Mario Brothers movie from Universal that also nabbed over $1 billion after its debut earlier this spring. And that's leading to a lot of bullishness on Wall Street when it comes to theaters, the theatrical comeback post-pandemic, the fact that we saw so many people attend that doubleheader Barbenheimer weekend just a few weeks ago. And earlier today, we saw Morgan Stanley analyst Ben Swinburne reiterating his overweight rating, on Cinemark stock. He also upped his price target to $24 a share, up from the prior $22. And that's just more upside to come, about 30% more compared to where we are at current levels. And he specifically cited Barbenheimer, the hype around that, how consumers really seem to want to get back to theaters. He did say that there is some uncertainty when we think about the double strike in Hollywood. We know that there's been really no progress on that. No more negotiations are being talked about at this point. But he did say that those uncertainties are short term moving forward. But it's something that I think everyone is watching closely, because the longer this strike goes on, the more we're going to see the impact specifically for theater chains, which rely on a lot of those new movies, new content. And if you don't have writers and actors, you're really limited. And I think the longer this goes on, the 2024 slate could be a little shaky. Yeah. But for now, everyone seems to think, let's enjoy the good stuff, the good news right now. And obviously Barbie and Oppenheimer as a positive.
Yeah, it is a positive. And Barbie itself, I just, in my gut, I knew it was going to be $1 billion movie. So it's joining this kind of rare club of movies, knocking some other people out of the club. Excuse me, my computer just did a little noise there. It's excitement for Barbie.
Fan as well.
Exactly.
No, there's only about 50 movies that have reached this milestone. I know you just saw Barbie this past weekend.
I did.
What's your review?
Loved it. I thought it was fun. It was funny. Clever. I thought, it just explored a lot of topics that you wouldn't expect. Loved Margot, loved Ryan Gosling.
Were people dressed up? Because I'm curious. Okay,
some people still were. So because, as you know, this is the third week out. So, and all the seats were full. So I was surprised to see all the seats full. So, I mean, maybe it'll bring it home for another weekend in a row.
And that's a big question with these films, right? Whether or not they'll maintain the momentum. And clearly Barbie is. So that's all good signs.
All right, Allie, stay with us. Let's switch gears. Disney reports earnings after the bell on Wednesday. Investors will be keeping an eye on the parks and experiences business. There's growing concern about demand amid high inflationary cost pressures, along with the future of the streaming business and plans to take ESPN fully over the top as a direct-to-consumer service. For more on this, we turn to Lee Cockrell. Lee is a former executive vice president of operations for the Walt Disney World Resort, and still with us is Yahoo Finance's Alexandra Canal, which is her wheelhouse as well. So, Lee, thanks so much for joining us. Let's start big picture. Let's start with Iger and Bob Iger with his return and what he's doing. I mean, he's made a lot of cost cuts and tried to, streamline Disney. What's your take on where where Iger is with righting the ship, if you will?
Well, Iger was there when I was there, and then I've been retired for some time. And I heard a lot of things when Chapek was there. And I heard a lot of cheering when Bob came back. And I live 6 miles from Disney World, and so I get a lot of feedback about how excited people are to have him back. And he's got a special way of working. He knows the customers and the employees, the cast members know everything you need to know. And I think he's opened up the allowing the park executives to make decisions instead of being held back. So it's pretty positive. So same old story. He creates the right culture, and people like him, and they trust him, and he gets involved in a positive way. So it should be good.
But Lee, what comes after Iger? Because we saw the board extend his contract by another 2 years. It was also interesting to see Tom Staggs, Kevin Mayer, former Disney employees come back on as strategic advisors for some of the problems that Disney is going through, like trying to take ESPN fully over the top. What do you make of the leadership outlook moving forward for Disney? Because that has been a concern for investors.
Yeah, if we could guess what that's going to be, I would place the bets on it. But I don't know. I think maybe it's going to be one of the guys he's bringing back, or that's a big challenge at Disney. It always has been for years, because Michael Eisner and then Bob stayed there for long, many years, and didn't turn over like a lot of executives do these days. So they were steady and long term, and it's a different product. We have Disney World is the only part of Disney and the parks that have real guests. The rest is all movies and retail, and it takes some talent to be able to do all of that and to lead that effort. Bob set a good example, but I don't know what the plan will be to get him replaced. I guess that's why he got extended again for another few years, besides the 2 years he committed to. So I'm sure they're all busy trying to figure it out.
And I want to ask you about the parks in particular, especially when you think of just the cost in general and pressures that some consumers have, and what we're seeing with regard to consumer spending, and consumers have been spending on experiences. Is there any cause for concern about how much strength the parks will continue to have for Disney?
Yeah, I think the cost thing's always been an issue. Every year it's an issue for the last 25 years. I think that's on every product from any company that raises prices. There's a lot of attention to it. And of course, Disney is especially in the spotlight when they have a price hike. But I don't think the price will be an issue. They'll feature packages. They'll find ways. They just done a big annual pass holders program in Orlando, and the results were unbelievable. The number of people came back out and bought their annual passes. They're changing a lot of the rules to simplify the experience for guests. Now that I would say that Josh DeMero and Jeff Volley, who runs Disney World, have the authority to do that. So you're going to see a lot of changes coming, I think, in January with eliminating this reservation system, the meal plans coming back, which saves families money, reservation requirements, all of those kinds of things. You're going to see a lot of things going back to the way they were before Mr. Chapek was in place.
And Lee, what about Bob Iger's current battle with Florida Governor Ron DeSantis? Do you think that's had any impact on park attendance? Last time you were with us, you said CEOs cannot ride the fence on political issues anymore. Do you still stand by that?
Well, I think it's tricky. I mean, how do you I think Disney is doing the right thing. And I think, if you lose the culture and you lose the trust of your employees, it's even more slippery. Because what makes Disney World is the cast members. I mean, people will tell you, out of the thousands of people we hear from every year at Disney World, they always talk about how great the cast is, the employees, how well they treat them, the empathy. So, yeah, as we know, many companies are going through this right now. It's a tightrope, and I don't think that the DeSantis issue is going to be a big one. I think that will fade off into the sunset. Every kid, I could go do a survey with children. I can't find any children who don't want to go to Disney World. So it's always the parents are the problem. Parents are always complaining. Kids are happy as a lark. Kids are happy if they just go to the water fountain. So, so far it's 100% kids want to go there. So we'll see how long this, I hate to say it, but all the reports, there's a lot of people that like to write bad things about things when things are not going well for a company. And so I would take all of this press with a grain of salt. It's not the end of the world. And Disney's about to come up next year to start celebrating their 100th anniversary.
Well, that will indeed be big. And to your point about Disney, definitely the kids, because my son says his favorite vacation, well, it's a little bit of a tie for different reasons, but his best vacation, he said, was last year. We went to California. We went to Disneyland. There you go. I did like it better than I expected because I've been to Disney World once before. It was overwhelming for me as a parent. So, yes. Yeah. All right.
Did you like seeing him be happy?
I did. I love that. So yes, would I go again? Yes. So we will have to leave it there, though. I appreciate your time. Love your Mickey in the background. Disney EVP Lee Cockrell. Thank you so much. And of course, thanks to Alexandra Canal. Coming up, the closing bell on Wall Street. We're checking in on the latest market moves and the top trending tickers. Stay with us.
Good morning. This is Yahoo Finance.
Big news. 3 things that you need to know.
We just got the announcement.
What happens now?
Now, I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings, and they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
All right, we've got the closing bell on Wall Street as we kick off a new week with investors pouring back in. Let's do a check of the market sponsored by Tasty Trade. We want to look at the Dow, which has been the leader all session. It is better by more than 1%, finishing the day up more than 400 points. S&P 500 better by nearly 8%, up 40. The Nasdaq also on the plus side, adding gains of around 85 points, up more than 0.5%. Let's take a look at some stocks that we are watching, trending tickers. Taste the soup, apparently. Campbell Soup has agreed to acquire, you know that reference, Jared, acquire Sovos brand in a $2.3 billion. Now shares of Sovos spiking on the news, jumping 25% sharp spike there. Shares of Campbell, though, closing down by more than 1%. And of course, Jared, we often see that in an acquisition kind of situation. The buyer, loses some ground, whereas the one being by exactly. I was like, what do we call this guy now? For people who don't know, you're seeing some pictures there. Sovos Brands has a variety of products, including pasta sauces, dry pasta, soups, and frozen entrees. The famous Ralph's pasta sauce is under Sovos.
Yeah, and they got some synergies there with Campbell Soup. They have the Prego brand, but there's also, I didn't know this, there's also Noosa yogurt, which is in the mix here. Bloomberg Intelligence does have a report about this. They said it could be spun off. Now, if you take a 1.12 times price to sales metric, they could sell it for $242 million. So maybe a little action there. And since we got the Wi-Fi interactive up, just leave it up there. I'm going to plot some Campbell Soup price action here. This is a stock that is down 22% year to date.
Looks like it's low for the year.
Yeah,
right?
well, if you pay attention to the market, guess what? Everything else is up a lot. So staples in general not doing as well, but certainly not executing as well as its peers, Campbell Soup. And you take a look at a longer term chart. This is a max chart, just really back against this very long-term trend line going back to the late 1980s.
You took it back.
Yes,
Jared,
I did.
Because of my reference, Taste the Soup.
Exactly.
I
was going back
to. Don't know coming to America.
Thank you. I don't feel quite as old here.
It's all right. We're together on this.
Exactly. Well, I got to move on here to Berkshire Hathaway. The Class A and Class B shares of Warren Buffett's Berkshire Hathaway ending the trading day up there. You can see it's a record high for both, each up about 3.5%. The rise comes after a strong earnings report that saw profit gains from its insurance business. It wasn't just insurance business that did well. Diane, I'm noting strength in insurance underwriting, manufacturing, service, retailing. And it's important to remember, this is a conglomerate that also happens to be Apple's biggest shareholder.
Right.
What did not do well, railroads, utilities, and energy. So some of the more boring stuff, but also important because we know that they own railroads, and that's a huge, the transports have been actually on fire recently, but maybe not taking as much of that sales with them. So they're lifting the price, KBW is lifting the price target to $565,000 per share, and that's up from $545,000 per share. And those Class A shares, wow, $500,000 for one.
I saw that. I looked earlier just to see where they were. I remember when I don't remember, they were always the more expensive class of shares. So it was never, like I can't get into this. But now it's, too sweet for just about anybody's blood. And, to your point about just every business that Berkshire is in, they're, we know they're seen as just a proxy for kind of the economic health of the country, really, because just the wide-ranging businesses they have, although, the segments that you talked about didn't do as well, but certainly the insurance and then that cash pile. Ali G talked about that earlier, that the company
and it looks like they're going to be sitting on that for a while until that next big thing comes along that they want to buy.
Right. Let's talk chicken now, from
let's do
soup
chicken.
to Berkshire
I
to
love
chicken.
the segue.
I don't know the analogy, but soup to chicken. Shares of Tyson, though, closing down more than 3%, more than 3.5%. The drop coming after the company reported missing earning estimates on both the top and bottom line. Tyson also announcing it is closing 4 chicken plants in an effort to cut costs there. So, we know they've already slashed some jobs ahead of this, and they shut some other plants earlier this year, but certainly investors taking a bite out of that stock today. Sorry, I had to do a little pun there.
That's okay. I'm just going to move right beyond that. No, Stevens, this is an analyst from Stevens saying on the numbers here, we view the company's decision to close 4 underperforming chicken plants as a positive, even if it comes with sizable goodwill impairment in the period. That means having to write down those assets because they're not worth as much. And then we continue to believe earnings are clearly approaching a trough, and we think that the stock should continue to be on the radar screen for a long-term and value investor who can be patient. They are keeping the stock at a price target of $70 with an overweight rating. But let's pull up the Wi-Fi Interactive here. Just let me show you Tyson Foods. This is another consumer staple, different than Campbell Soup for sure, but also very depressed right here. And you can see on that chart, and I'll do a max chart. Maybe we can go back to the 1980s on this one. And yes, we can. Lots of volatile action up here recently with respect to the pandemic and everything. But I'll just send it to you here.
But also, when you think about that $70 price target, I don't know. It's got a lot of room to grow if it even,
Well, and they have a lot of competition from Beyond Meat and et cetera.
And they have to execute on those cost cuts. All right, switching gears. AI in a classroom can take many forms, from teachers using it to help grade and monitor their classes to student research and learning approaches, but it also raises issues of authenticity, plagiarism, safety, and fairness. It has rung many alarm bells in both classrooms and boardrooms, as well as the halls of the White House. We're currently at the beginning of this new technology boom, and it's only getting bigger. And one of those companies that's trying to harness AI in education is Paper. And the founder joins us now for Insight. Phil Cutler, thanks so much for joining us this afternoon. So let's talk about first what Paper does, and then I'd love for you to get into how you are incorporating AI.
Well, Diane, thank you for having me here today. Paper is really an organization that focuses on supporting communities by working with the school districts. And we do that by providing students with academic support, and that can come a number of different ways. We're best known for our online tutoring, which provides students with support 24/7. We also have a practice component that lets students sharpen their skills. And then probably the most important piece of a student's success is building a plan. And so there's a whole aspect to our platform that helps students build a plan that ultimately gives them the direction and guidance to be the best student and be motivated in their academics.
And tell me a little bit more about this plan. I believe you're saying you can develop this plan within a short period of time. What are the metrics in terms of it needing to be revised, just in general? Because this seems to be some cutting edge technology with respect to the teacher-student interface here. How are you approaching this?
Well, Jared, the number one thing that drives student motivation, and we can probably all relate to this to a certain degree, is connecting our courses to our personal interests or our career ambitions. And the biggest mistake that we make as a school system is oftentimes we don't give students that context. And so what Paper does is we help have students connect their personal interests, so their career ambitions, to the courses that they're taking. And that allows them, as they develop and grow, to stay motivated to do well in the courses that they're enrolled in. And we also provide them with the support in order to excel in those courses, to learn the material that they need to learn. And it's constantly adapting, right? As students grow, as they move from first grade to second grade to fifth grade to 12th grade, they're constantly going to be evolving, and the platform evolves with them as well.
So, Phil, I want to get into something that Chegg talked about recently, and they've just put out their quarterly results as well, seeing revenue decline. And recently, they talked about just the impact of AI on their business. The CEO saying they'd seen a significant spike in student interest in ChatGPT and believing it had an impact at the time on their customer rate growth. Not sure yet in terms of their decline in revenue, how that's impacted their business. What about ChatGPT when it comes to your business? Is it friend or foe?
So we look at all of the generative AI tools as opportunities to better personalize the experience for students. I think in the case of Chegg, and what Dan is alluding to is, they're in a consumer market where a solution like ChatGPT comes along and it's essentially free for students. It can be really competitive, right? At that price point, it's difficult to justify the investment in a lot of the tutoring offerings that they may have been providing. In our case, we're providing this through the school, and it's not just about the academic support. It's actually about personalizing the experience even further. So from our perspective, the role that generative AI can play is to be able to provide a level of personalization, both to our tutors, but also to the classroom teachers, so that every student does have that connection to their personal interests or their career ambitions that they couldn't necessarily have before. We wouldn't be able to provide that level of individual attention to every single student's interests without using some sort of AI.
Now, Phil, I want to ask you that you have done some layoffs over the past year. Do you expect for you use human tutors to be replaced by just AI, by generative AI, for instance?
Well, the way we're looking at it is not a replacement to the tutors, but rather an augmentation of their ability. And what we're trying to do is provide them with more insight into best supporting each individual student and those students' needs. And so, my learning style may be different than your learning style. Our AI is actually supporting the tutors to help them either through prompts or other methods in order to make sure that each student's experience is sort of unique to their own interests and what they want. So it's not necessarily replacing them. And I think that's not really the goal in terms of how we look at it. It's rather, let's make their job easier and let's make them better at it so that the student experience is ultimately the best it can possibly be. Because at the end of the day, our goal is to give every single student the tools and resources that they need to reach their potential.
All right. Phil Cutler, founder of Paper. Thank you so much for the time. All right, coming up, earnings season rolls on. Shares of Paramount Global are popping after its second quarter results, up about 3%. Those numbers and much more when Yahoo Finance returns.
Welcome back. Paramount stock, it is up over 7%. That's after reporting earnings. And here are the numbers. First of all, their second quarter revenue came in at $7.62 billion. Diane, the estimate was for a bit lower at $7.43 billion. Also some other numbers, their direct-to-consumer revenue, $1.67 billion. The estimate was for lower, $1.57 billion. I think what was capturing the investing public's attention here is some news here. KKR is going to buy Simon & Schuster from Paramount Global for $1.62 billion. And this is after the closing of the transaction. Simon & Schuster is going to become a standalone entity. It looks like Jonathan Karp, president and CEO, is going to continue.
Yes. Yeah. So this is something like we were watching for this to come in. It is a beat, but again, this is something that we've talked about all earnings season, that it's kind of low bar for companies. Paramount jumped over it, and one of the things that we will probably hear is more about the strike and the impact. And we've seen that be accretive to companies in terms of currently the amount of cash they have on hand. But in the long run, it can have a negative impact to the company. I mean, in their press release for their earnings, they're saying they maintain their focus on scaling streaming platforms. We've heard a lot about that from different companies in that space. And yes, the stock is popping on the back of this news, but it's a long way from where it was before. I used to work for CBS, which Paramount is the parent company. Mm-hmm. And so as an employee, we had some shares there, and I sold them a couple different times. Once when it was around $100-something a share. So right now, what is it, sitting at $16 a share?
Can we go to the Wi-Fi Interactive? Because I want to chart this. This is really interesting here.
I am glad I got out at that level.
Yeah, here's the year to date. You can see the low here is about, 14, 15, but here's a 5-year chart.
Yeah.
Remember Archegos back in the day and the GameStop mania? Anyway, this was kind of separate, but that was a huge spike up, and of course that was given back pretty quickly, but glad you were able to monetize some of that, Diane.
Yes, and then one other level around $40-something a share. Just finally I was like, okay, I'm just done. Everything is being sold, and I'm so glad I did. I don't care about this jump today. Right. All right. Again, shares of Paramount trading higher, up about 7% after its earnings. The company beating on both the top and bottom line. Paramount also announcing investment management company KKR will purchase Simon & Schuster from Paramount for $1.6 billion. For more on this, we want to turn to Wade Payson-Denny. Wade is PR and communications manager for Parrot Analytics. So, Wade, thank you so much for joining us. At first blush, in terms of these latest results, what's your take on Paramount?
Well, first, congrats to you on getting out at 100. Well done. But this is, I would say kind of to be expected. We have seen Paramount Plus growing its market share with originals, with on-platform, had a really good quarter in terms of both of those metrics. So, we often see that demand for original content is a leading indicator of subscriber growth. I think all of the media companies are going to report slightly better earnings this quarter, if anything, because they're not making new shows, because of the strikes. And then as far as the Simon & Schuster sale to KKR, I do think that's a sign of things to come. I do think more of these companies are going to be selling off linear, kind of like old school media arms to private equity as we move forward.
So do you think this is part of the great consolidation in streaming that people have been talking? I've been talking about this for years, something that's probably coming down the pike, or is this just part of a larger media reorganization cycle that just seems to happen every 10 to 20 years?
Maybe a bit of both. Like I think Paramount Global, what they've done with Paramount Plus as far as effectively, closing off Showtime, bringing all of that content onto Paramount Plus, that has helped with scale. I find it's hard for us to see really how Paramount Plus makes the jump to that top 3 streaming category that clearly Netflix, Disney, and Warner Brothers Discovery currently have a hold on. I think they're certainly an important player. They have really beloved franchises specifically, Star Trek and Taylor Sheridan fans, like they're not going to go anywhere else. And there's a lot of those. That's a big plus for Paramount Plus. I think it does seem like, as far as Paramount Global is concerned, we saw reports of them trying to sell off BET earlier. Mm-hmm. I think, if KKR is willing to, actually make that acquisition, then I think either them or one of their competitors might be willing to look at BET, maybe even CBS. I think just based on the Simon & Schuster sale, I do think that, that's not the last time we're going to see this kind of thing happen.
So there has been talk before about them potentially selling off CBS, but could you see that really happening given the sports piece of the business when you think about how lucrative sports is, and especially given the NFL access that CBS has?
Yeah, no, I think I don't see it happening in the short term. That CBS has the Super Bowl early next year, at the conclusion of this season, and that's what, like $7 million for 30-second ads. Yeah, they're not going to get rid of that anytime soon. And look, the NFL, that's really the NFL owns linear TV. If you look at last year, of the 100 most viewed broadcasts, 82 were NFL games. That's up from 75 in 2021. And I do think that that's only going to grow, especially with the lack of, scripted series that we'll be seeing at the beginning of the broadcast season next month.
We got a little bit of time here for one more. I'll give you the floor. Anything you haven't talked about here that you think is important to talk about in the Paramount discussion?
I think that I think soccer is a big deal. I think if you look at not just, obviously kids playing it, those numbers are always growing. But if you look at soccer and television and streaming, Ted Lasso was a massive hit for Apple TV Plus. It really put Apple TV Plus on the map as far as like a home for Emmy-winning content. If you look at FX and Hulu with Welcome to Wrexham, the docuseries about Ryan Reynolds and Rob McElhenney's soccer club in Wales, that was a huge hit. Messi is just like taking over Apple TV Plus. Paramount Plus has the UEFA Champions League. That's probably the top. That's like the pinnacle of club soccer competition worldwide. So I think having that in the U.S. is going to be a big asset. And I think they'll they have the Serie A, which is Italian soccer. It's not quite as big as the Premier League, but AC Milan is now owned by American ownership. So I think they'll probably be taking advantage more of that as we move forward.
A different direction than I was expecting, Wade. I thought you were going to talk more about the impact of the writers and actors strike, which we'll certainly be watching if that, how much longer that takes and when it becomes damaging or more damaging to these companies. But we will have to leave it there for now. Wade, Pace, and Danny, thank you so much for the deep dive into Paramount.
Anytime.
All right,
Thanks.
Let's do a check of the market sponsored by Tasty Trade. We have all the major indexes. They finished on the plus side today. The Dow finished better by more than 1%, up 407. S&P 500 up just shy of 1%, up 40 points for the day. Nasdaq better by 85, up more than 0.6%. Coming up, shares of Palantir Technologies in focus, down off 1%. It released its latest quarterly report card. We will break down those numbers on the other side. Stay with us.
not enough to know what's happening now. You need to know what's happening next.
I'm Dan Howley, and this is what's next for Samsung.
You can put it in the water.
That's pretty gnarly.
Innovation is changing our world.
This is the heart and soul of astrobotic. This is where we build our landers that go to the surface of the moon.
Is the future high power, bigger boats? How easy is it to take the battery out, do the charging thing?
Imagine being able to charge without ever plugging in. It's becoming a reality thanks to technology that's hidden beneath my feet.
We'll show you what tomorrow will look like today. Join us for our new series next.
Palantir shares slightly higher now, a whopping 83 basis points. That's coming off the back of its second quarter results. Revenue coming in at $533 million, slightly beating analysts' expectations. And while earnings per share came in line with estimates of 5 cents per share, well, joining us now to dig into the latest numbers is RBC Capital Markets software equity analyst Rishi Jaluria. We're scratching our heads here because Palantir stock was down 12%, and we were wondering about could it be light guidance with respect to their the future, which is really heavily dependent on AI. They have this new platform, AIP. We don't have a lot of details there. What do you think is going on with this report and the stock price?
Yeah, absolutely. Thanks so much for having me. Always a pleasure to be here. Look, I think it's a combination of a couple of factors, right? But this is a battleground stock. This is a name where I think a lot of retail investors look on Reddit, look on Twitter, have a high amount of interest in the name. And look, I think the stock should be down on this print. The stock has had a massive run up year to date, especially with all the hype around AI, which, and we can get to that in a second, but I do not believe Palantir is truly a generative AI company. And I don't think the reality at all matches the messaging out of Palantir. But just given that hype, you would have expected that they'd see upside on numbers, upside on guidance. But this was a very in-line quarter with their expectations. And by the way, we haven't seen all the numbers, but that probably saw some contribution from accelerated SPAC bankruptcies in the line, which juiced the bottom line as well. And the guidance, they say they raised the guidance, but in reality, they kind of maintained / maybe slightly lowered it. I think the one thing that's maybe the turning point of why the stock has gone from down to up is in Alex Karp's letter to the shareholders. He said that they're seeing more than 100 organizations on AIP today and in discussions with 300 others to deploy AIP within those organizations, which are figures that sound impressive kind of on first glance, although I would really want to push at exactly what those mean. What does monetization look like? How real are those? And what is the real revenue opportunity with that?
Rishi, I want to ask you just to expand on something you just said. I mean, you said it should be down on the print, and you don't believe that it's truly an AI company. Why do you say that?
Yeah, look, I look at what the leaders in generative AI today are doing, right? Look at OpenAI, look at Microsoft, Anthropic, Google, Hugging Face, even Llama through Meta. And what Palantir is doing is not even close to that, right? I think Palantir has some fantastic technology. This is a data pipeline company that can help you make a lot of sense out of your data, but it is not doing generative AI. And as I'm talking to CIOs and head of IT, what they want is real generative AI, right? They want to figure out how do we take the powerful solutions like what we see with OpenAI APIs, like what we see with ChatGPT, with Llama, and apply that to our enterprise. And that's kind of what Palantir's promising, but that's not really what they're doing, all right? They don't have any of their own large language models. They're using third-party LLMs and kind of plugging it into their very heavily customized software. And that is why I say this is not a generative AI company in my mind, right? And this is supported by conversations I've had with technologists, with CIOs, even with people from Palantir themselves, obviously not the executive team. And so even though they message a lot around being an AI company, I would say what they're doing compared to like what Microsoft is doing in generative AI, Microsoft is far ahead of them.
Rishi, you said something interesting at the beginning here that I want to hone in on, and that's there are a lot of retail investors very much eyeballing this report and the stock. If we can go to the Wi-Fi Interactive, I just want to show a chart of Palantir since its listing, and here's that big spike that came in early 2021 when it apparently, I was scratching my head at the time, was a meme stock, but nevertheless, you saw it shoot all the way up to about $36. It crashed about 85%, and now it's up again. How much of this latest rise do you think is just because of retail investor enthusiasm, AI enthusiasm, and then what does that portend for the future? Because if it's just fluff, well, a lot of times it just comes back to earth.
Yeah, it feels like this is a very narrative-driven sort of story. You know, the kind of bubble when it first went through its direct listing, at least you had impressive numbers to support that. Now, that was all a lot of COVID-related spending and a lot of one-time government outlays that really juiced up those numbers, and that's why the stock kind of fell down to earth. There was a little bit of a mini rally on the narrative that Russia, Ukraine would be a benefit to them in a big way, and that did not actually show up on the revenue line. Now it's around that AI narrative, but look, the fact that they have all these pilots they're talking about on AIP, but it's not showing up on the monetization side now or next quarter or the following quarter, in spite of all the hype that they've been making out there, I think that tells you that this is a story where the move in the stock, to me, is not justified by the actual underlying fundamentals. And even though I am a huge believer in generative AI, I think this is transformational technology akin to the internet and cloud and mobile computing. Palantir is not a big beneficiary of that. And you know, the numbers still matter at the end of the day, and the numbers just aren't there for Palantir, nor do I expect them to be there in the near term.
So you talked about Microsoft, but I really, and obviously we know that Microsoft is a leader when it comes to generative AI. They made that open AI big commitment. But when you look at Palantir, I mean, one of the things that the executives there have talked about is just really increasing both the business focus and even tying employee compensation to just the growth of AI. Does that messaging not matter to you?
I think that messaging matters. I think the question is, we have to really look under the hood of the technology and say, is what they're doing AI, or are they AI washing what they're doing, right? Are they taking an existing product, plugging in LLMs that other companies have come up with and saying this is now our own AI product? And it feels like the latter is most likely the case, right? I think, look, there's better ways for investors to play generative AI as a trend. You know, it doesn't only have to be, you know, the Microsofts and NVIDIAs of the world. Like, I think look at HubSpot, look at MongoDB. Those are both great ways to play generative AI in my mind, and companies that are actually doing really interesting things around generative AI. So that's why, you know, even though Palantir is saying all these things, I think we have to really talk to them and say, what is your definition of what is really AI and not? What are you doing that's truly differentiated when it comes to generative AI versus others in the space? What are you doing that a Snowflake or Databricks isn't doing today, because those are their most significant competitors along with Microsoft? And more importantly, you know, is this, like, when you talk to the actual customers, is this something that they're willing to pay for and pay a big amount in the long run? And if the answer to those questions is not yes, then I don't think this should be the most expensive stock in all of software, which is where it's sitting at today.
Definitely another head scratcher there, but really appreciate you walking us through all these numbers. Rishi Jaluria, RBC Capital Markets, software equity analyst. Coming up, Musk versus Zuck. The cage match could be put on hold, and Warner Brothers may be taking a swing at streaming live sports. We're talking some of the top trending stories of the day when Yahoo Finance returns.
I think they would both fold in 5 seconds. I feel like Mark would bring some moves, but in the end, Elon would beat him.
It may be wise to have some sort of contingency plan.
I'll take Elon.
We don't need to rush, you know. Look, what's the hurry?
Definitely Mark Zuckerberg. He seems like someone who would go a little crazy and beat Elon Musk up, and Elon Musk is like all talk. It'd be embarrassing for him, I think.
I think that's gotta be true.
I think Mark may have the skills.
I do think it's going to be very interesting to see how this plays out.
I'll put my money on Elon though, because I feel like he's a little crazier.
Oh, wait a second. That's the exact opposite.
People say that Mark Zuckerberg actually does like some form of martial arts.
I like jiu-jitsu. I also really like MMA. We have like a mini academy in my garage.
So I guess my money's on him.
It's awesome. I got like a ton of my friends into it.
I don't care.
I don't know, I think Elon Musk probably.
You know, hopefully this can serve as an inspiration for excitement about the future.
I think if they both managed to kill each other, the world would win.
Welcome back to Yahoo Finance Live. I'm Alexandra Canal here with Praz Supermedian and Josh Schaefer. We are in the office, in the studio, and apparently a lot more people are going to be back in the office because we got Zoom telling employees they need to come back. We have Google actually offering a quote-unquote summer special for employees, basically $99 a month. You can stay at the on-campus hotel and just have an easy breezy walk to work. I'm not sure who'd want to do that, but apparently that might be cheaper than having your own apartment.
It gets back to sort of what the tech benefits eventually people started realizing that they were over the last 15 years, right? Which is benefits to make it so you can work more and don't have to leave the office. Like there's a reason companies like Google in the past have done places like where they have people walk your dog, where they feed you multiple meals, where they give you all these benefits. So then you can essentially work 12 hours a day without having to leave, right? I think there's a little bit of that being the underlying pitch here. But also just, are we headed back, Pross, to like, okay, so we stopped doing all the tech benefits, right? A lot of those companies cut back on a lot of different things that were happening within the office. And now we're just going back to that to get people to come in the office? It doesn't quite make sense to me, right?
Well, paying $99 to stay at a company-owned hotel doesn't sound like a good deal to me, right? I mean, I understand it's unapproved
it's
travel,
your own money.
so you got to pay for this, and they're saying, oh, it's like $3,000 a month, you know, give or take, and it's better than like San Francisco real estate. Okay, but is this supposed to incentivize me to come to work? I don't know. I mean, especially when you talk about the fact that companies are making so much profit. Google making a lot of like billions of dollars, and they still say we still want people in the seats. Why? Am I missing something? Why do we need to be in the seats from a Google point of view if they're doing so well? Profitability, productivity.
No,
that sort of thing.
that's a good question. I do have friends that pay out of pocket for hotels. My one friend lives in Philadelphia, and he comes into New York twice a week. He pays for one hotel overnight to go to the office 2 times a week. Now, his company is starting to say, we need you here 3 to 4 times a week. He's trying to figure out what his next step is if he's going to buy the apartment in Manhattan.
Becomes the employee's problem, right?
Totally,
if
but
you
I'm
started
saying
working a job over the pandemic in a place you didn't live, you created
He did get remote approval though.
Yeah,
which is what's happening.
But then they were always going to come back on it. You can't trust companies when it comes to that kind of stuff.
It doesn't make sense, though. I don't
think
it makes sense.
If you can do the bulk of the week remote, I do get it. Now, in Zoom's case, it's interesting. If you live...
Zoom is saying, come in.
Zoom basically saying,
that makes no sense.
They're only saying 2 days a week, and if you live within a 50-mile radius. But you're right. Now that I'm thinking about it,
they are Zoom, like
I know it's not a good business.
From like a PR perspective, you would think you just shouldn't even offer that.
Or don't say it.
So I know someone works at Amex, and they brought them back, and it's because hey, our business is expense charges, cards that people traveling. We want you to be in the office buying lunch, doing sort of stuff. So I get that. It's like the MO of the company. Like why do we exist?
Want you to spend.
Zoom should be like none of you guys come into the office. Everything can be done remote, right?
Well, one of the reasons some companies want people back in the office, right, Pross, is so some of us aren't watching March Madness and other sporting events in the middle of the day,
Doing double duty.
Yeah, and so one of the stories I was tracking today out from CNBC was actually that Warner Brothers Discovery is going to start targeting MLB playoffs and potentially March Madness down the line to put on their streaming service Max. So currently you can't watch live sports on Max to that extent. They're going to offer MLB playoffs this October and actually offer for people to pay. Well, I guess not offer, make people pay more if they want to watch MLB playoffs on Max. So seeing sports coming to streaming here and Warner Brothers sort of making that play. Pretty interesting, Allie. I know you're in the streaming space, so I'm curious just broadly your takeaways from the report.
Yeah, and Warner Brothers, they said they were not commenting on this report. However, on the earnings call last week, we did hear from CEO David Zaslav that said, we're going to have something to you guys soon when it comes to sports and news. Those are clear differentiating factors right now in the streaming space. And for Warner Brothers Discovery, they have the Bleacher Report. So they have different levers to pull here when it comes to sports. It will be a separate tier. So like you were saying, you'd have to pay more to access this. You'll have access to certain games. You'll have access to highlights. The NBA, they're renegotiating their contract. Right. It's expected that in that contract, they'll select certain games to be on this streaming tier. But the big question is, how much do you charge folks, right? What
for MLB, it better be cheap. It better be cheap if you're going to charge someone to watch it.
And that's a big question. I mean, Disney is trying to take ESPN fully over the top, direct to consumer. I've talked to many analysts who say they're going to have to charge at least $30 a month. People don't really want to pay that much.
So we were talking about this earlier today, and so the Cubs now are surging, right? I'm really excited about this. And I'm saying I would pay to watch those playoff games if that was my only choice. But I'm also a fan that just sort of like following not that closely, and now I'm into it. Someone like you guys or who are not casual or who are more casual, you're not going to pay to watch playoff baseball. Yes. So that's kind of a question I think is kind of an issue maybe for Warner Brothers or Discovery. But then at the same time, maybe this is the future, right? I guess the World Series last year was the second worst watched World Series last year. So is the future going after those really committed, really enthusiastic fans and getting them to pay, and maybe you forget about the wider population?
Well, it gets back to what we were talking about with the Nickelodeon broadcast of the Super Bowl that might happen this year. Last week, we talked about just paying so much to have the inventory, right? When you're paying billions of dollars to have these sports media rights contracts, I think you're going to keep seeing streamers find different ways to get them out to people. If you can do it via cable and then also somehow have a streaming option, you're paying a lot of money for those rights, a lot of money. Yeah. You want to find a way to make some of that back, and that's a great direct way to do it, making people pay.
I think there needs to be a way, to your point with the casual viewer, to turn on and off the service pretty easily, because you're right, maybe if my team is knocked out of the playoffs, I don't want to keep paying for this service over and over again if I'm not using it.
Oh, like an instant opt-out?
Yeah,
like the Phillies lose in like the first round and then you just opt out?
I think there needs to be some product enhancements on that side. I don't know if they'll do it, but if you're charging people $30 a month, maybe you have to.
You know, it's funny you mentioned that. You said Bleacher Report's going to be kind of like the sort of the property that would be owning this broadcast. When I was in Chicago, I know this segment's all about us, right? The PGA Corn Ferry tournament was on. That's like the lower level minor league tournament for guys wanting to get their tour card. That was supposedly broadcast on Barstool Network. So the first tournament that was, or sporting event broadcast on Barstool. Maybe we're seeing some of these smaller properties and more niche properties that these companies, big media companies own. Let's put sports on there. See, maybe that'll like generate up some demand here. I don't know.
Yeah, I mean, and this will be a tier of HBO Max now. Right. Now it's been rebranded to that. But you do wonder how the rollout will be. But I do expect David Zaslav to roll that out, or at least make some sort of announcement in the coming weeks or months.
So speaking of streaming, this is one thing that I'm really excited about, is the Musk versus Zuckerberg fight. So Mark Zuckerberg put out a kind of a note saying on Thread saying, it'll be August 26th, is that right? Yes.
It's coming up.
He wants 26th. That's my date. When you hear back from Musk, and he said crickets, right? Musk's right back. Right, oh yeah, I'm down for that. But hey, actually, I got a neck injury. I got a back injury. I need an MRI. Got to check that out. Potentially, that might affect the date of this fight. And I'm thinking to myself, is this sort of Musk's way of weaseling out of this fight after he sees Zuckerberg training MMA guys? Zuckerberg sort of also a big fan of martial arts here. I don't think Musk does any much fighting.
This whole thing was obviously kind of a joke from the beginning, and we were making a lot of like bro culture jokes about this, right? It's like two bros online being like, oh, I could beat you up kind of stuff, or I could beat you in golf, and then you realize the guy's a scratch golfer. And I think Elon Musk went on the internet after doing this and was like, maybe that guy's kind of ripped. Yeah. Oh, he's training. Oh, maybe he's in better shape than me. I at least need some lead time, versus when you're Mark Zuckerberg and you're thinking, wait, I just took a look at Elon. I've been training way more for this. I want this tomorrow.
And my back's hurting. Hurting.
I mean, does either CEO really want it? It's so silly.
If I were Musk, I would do it and put it on Threads, seriously, just to get more people to download Threads.
So
it would be
who
significantly
has more to
worth
win
it.
here, Musk? Like from a company perspective.
I think Musk has more to win if he's just trying to grow, sorry, I said Threads, if he's trying to grow X. If you're trying to get more people onto X and you can come up with something to get people on X here, and you could argue the same for Zuckerberg too. If it's only available on those two platforms, you're going to get downloads, you're going to get eyes, so I could see why they'd want to do it from that perspective.
I agree with that. That would be a way to do, I mean, just to do it seems so
But it's funny that Musk said it'll be on X, and Zuckerberg could be like, wait, what about Facebook Live?
You could not show, right?
Instagram, like, what
you
about
still have
my
Facebook
program?
Lives?
Yeah, I think so, don't they? Channels, TV, I don't know.
We're old
Instagram
now.
Live.
But you know what? I will say we showed a little video, and Musk won for the who will win in a fight. I think Musk will also win.
I know you've been saying Musk.
I've been in that camp from the beginning.
He is.
This is why we need the fight to happen. I need a real answer.
He is bigger. He's bigger. All right.
Okay. All right. We'll be right back.
Welcome back to Yahoo Finance. Let's take a look at some of the stocks trending in the after-hours trading. We've got Paramount, Lucid, Beyond Meat, and Chegg. First, starting with Paramount, the company coming up with losses that were lower than expected. The company reporting a direct-to-consumer loss of $424 million, up from $425 million last quarter. And then when you take a look at the revenue of $762 billion, higher than the 7.43 billion expected, and the company's adjusted EPS also coming in better than expected at 10 cents versus what the street was expecting at 0 cents. And then when you take a look at Paramount year to date, you can see that the company had been beat up pretty bad on earnings in May. That was on some losses in the streaming sector, so that's why it seems like the street is probably happy with what they saw today. Again, shares up 3.6% after hours right now. Then you take a look at Lucid Group, shares also in the green. Lucid reaffirmed their production outlook for the year. The company still believes it will produce 10,000 vehicles this year. Again, when you take a look at Lucid year to date, you can see that the stock had been down thus far this year. The company also reporting revenue of $150.9 million. That was short of the street estimates, but it seems like right now investors really hanging to that production outlook, remaining steady. Beyond Meat, shares are in the red right now. The company saw full year revenue coming in at $360 million to $375 million, well below what it was initially projecting. So Beyond Meat was initially projecting revenue of $375 million to $415 million. So you take a look at what Beyond Meat's done year to date, stock had been up a decent amount, they're cutting that revenue forecast, shares are in the red right now. And then finally, a company I love to follow, Chegg. It's been a little bit of an AI story thus far this year. You can see shares up over 25%. EPS came in line for the quarter, but the big number here was revenue, $182 million, above estimates of $176 million. CEO Dan Rosensweig noting that the feedback on the company's AI experience has been very positive. Again, you take a look at Chegg year to date, AI had been a big headwind for them. Right here is when they mentioned last quarter that ChatGPT might be a headwind for them and weigh on the business. Now they're having a little bit more positive a tone on AI. Shares up 25% after hours.
All right, good stuff there, Josh. It is closing time here at Yahoo Finance. Here's what you need to know to end your day. Changes at the helm. Tesla CFO Zachary Kirkhorn steps down after 4 years in the role. Kirkhorn had been at the company for 13 years. Tesla's chief accounting officer was appointed to the position. Kirkhorn's departure marks the second CFO replacement at Tesla in just over 4 years. Meantime, Apple is launching another iPhone. The unveil is expected on September 22nd. It's anticipated to be the most technologically advanced device in 3 years, according to Bloomberg. The company did warn last week that the industry is facing an iPhone slowdown. Apple reported slowing sales of the iPhone in the second quarter, the company blaming the slowdown on currency headwinds, but also admitting U.S. shoppers not buying the iPhones as much as they once did. Paramount shares jumping after the company reported mixed quarterly results. Paramount also announcing that KKR will purchase Simon & Schuster in a $1.62 billion all-cash deal. The difficult TV ad market, however, continued to be a headwind, with linear ad revenue slumping 10% year over year. Management maintaining that the second half of the year will see improvements in the ad market.
Time now for What to Watch on Tuesday. Expect to hear new Fed speak from two different officials. Philadelphia Fed President Patrick Harker is going to be giving remarks on the economy at 8:15 a.m. Eastern Time. This will be followed by Richmond Fed President Tom Barkin, who will be speaking at 8:30 a.m. Barkin also expects to deliver remarks on America's economy and its urgent challenges. Meanwhile, on the earnings front, investors look to results from UPS. Fuel costs and shipping volumes to be key focuses for the second quarter. And whereas investors are going to be keeping watch on mentions of the recent contract deal struck between the Teamsters Union and UPS. And after the closing bell, meme stock AMC will release its latest quarterly results. Blockbuster movies such as Guardians of Galaxy Volume 3 and Spider-Man Across the Spider-Verse may provide a lift for the second quarter. Meanwhile, the impact of Barbenheimer may paint a rosier picture for AMC's third quarter outlook. However, the company's liquidity issues continue to weigh on investors' minds.
And that will do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.